Welcome back, you guys. So this is actually my second YouTube video I've made on my channel. I've already made one going over financial markets. This one's going to be going over price charts. So I highly recommend you check that video out before watching this. It's just going to feed into it really well. So without further ado, I'm going to go ahead and explain what's on my screen. So as you can see, this is what's called a line chart, and it maps the price of what I have up here is the S&P 500. So it's just telling you where the price is, how much it's gone up and down during the day and over like a period of time. So in this video, I'm actually going to go over the line chart and what I think is more important, which is the candlestick chart here. So starting off with the line chart, this is more basic and probably what you guys are going to see mostly if you just go into a platform that has a price chart on it. It's kind of the default. So what are we really looking for when we look at a price chart? When we're trying to analyze a stock, currency, index, anything like that technically. So what do I mean by technically? It's, well, I'm looking at where I'm trying to time my entry point, where I'm trying to exit out a stock, looking at the chart. So as I said at the beginning of the video, I'm going to be going over a line chart and a candlestick chart. And so I personally, as a trader, use candlestick charts. I believe that they're better, as do a lot of other traders. And well, what makes them better? So in a line chart, you can really only tell one piece of data. And that one piece of data is really just the closing price. So with a candlestick chart, you're able to tell 4 pieces of information. And I'll get into that later. But the bigger thing is that as traders, we really want to use as much data as we can in order to influence when we want to get into a stock, if we want to get into a stock, and when we want to get out. So I know I'm talking a lot about candlestick charts and why I particularly like to use them better than a line chart, but don't get me wrong, a line chart can be helpful just to see kind of an overall trend. Like if I look at this graph right here, I can tell that, boom, overall trend is up. But I mean, that's really it. That's not helping me place my entry points better or get out at a better exit point. It's really just seeing an overall trend and strength of a company. Moving over to candlestick charts. So why do I trust candlestick charts more? Why do I pretty much exclusively trade off of candlestick charts? Well, they were actually invented by the Japanese in around the 1700s. And I mean, I just believe that tools that were invented that long ago and are still used today, I mean, they gotta work, you know. They don't last that long if they don't work. So now that I've enlightened you with that piece of history, let's get into what candlestick charts really are and what are candles. Because the difference between a line chart and candles are that they're actually individual. And I mean, you can kind of start to see that just on like, okay, I see a green candle, a red candle. They're different, you know. So while I say that candlestick charts can measure more individual pieces of data just by the candles, I mean, they still measure overall trends. So if I kind of flip back and forth from the line charts to the candle charts, I mean, hopefully you can kind of see, I mean, just like this line chart with that overall trend, I mean, I come back over to the candle chart, I can still see that. It's still right there. And so it's really not that much different. There's no negatives to using a candlestick chart instead of a line chart. I think there's only positives, as in there's more data. And well, what is that data? Well, if I just take this example of this candlestick I drew here. So let's pretend this is a green candle. Well, as you can see from looking at these different green candles in the actual chart, what does that measure? Well, it actually gives you 4 points of data. So if we're pretending this is a green candlestick, or even if it's a red candlestick, it'll still give you 4 pieces of data. It's going to give you the open, the high, the low, and the close. Each different prices. So the open price, where it opened at that specific time, the high that it got to during that time period, the low it got to during that time period, and where it closed at in order for the next candle to open. Even though each candle gives you a little bit of information, the way you're still able to see overall trends is by the time frame. So on TradingView, the time frame for each candle is right here, and that's what candles really do. Is each one of these. So I'm on the 5-minute time frame, right? So each one of these candles is a marker for every 5 minutes. So if you look, if you keep your eye kind of down here, when I go over this candle, you're going to see 1455. So that's at 255, and then it gapped to 830. So that probably didn't make a lot of sense, but so 830 to 835, 835 to 840. Again, I'm keeping your eye kind of down here. So 845 to 850. So they're 5-minute time periods, and that's what it measures. So because it's a red candle right here, that means in this 5 minutes, the price closed lower than where it opened, right? So that would be a red candle because it opened lower. This one, for example, opened or closed higher than the price it opened, so it's a green candle. It's in the green. So I know I just gave you the example of the 5-minute time frame, but when I go over here and I click on this, I can pull up different time frames. Now, usually I don't really get into the second ones. I usually use just the time frames I use. I use the 1 minute, the 2 minute, the 5 minute, 15 minute, 30 minute, the daily, or I'm sorry, the 4 hour, the daily, and that's really about it. I know that might seem like a lot, but I don't use them all at once. So what do I mean by that? So a general rule, or not really rule, but more of a general kind of guideline is if you're looking to day trade and you're kind of doing it, obviously actively, is you're going to want to use the 1 minute time frame. I know that kind of messes up the graph here. So these are now, instead of 5-minute candles, they're 1 minute candles. So this candle, again, keeping your eye kind of down here, you can see at 211 there, and then 212, 213, 214, 215. So they're measuring 1 minute increments. So if you're on the Snapchat community that I created, and this is also going to feed over into the Discord when I'm finished making it, you'll see me or other members might say that, I don't know, just for example, like if I said SPY, I don't know, downtrend, 5 minute. So you might have seen me say something like that before. All that really means is I'm seeing this downtrend and I'm on the 5-minute time frame. That's really all it means. So if you saw what I said and you wanted to look at it for yourself, you just know to go over the 5-minute time frame so you can kind of see what I'm talking about more. With that being said, so I know we talked a little bit about let me fix this here, about trends, and just kind of like looking, hey, see, it's a overall uptrend. Now, that's helpful, but like I said earlier, we want as much data as we can possibly use in order to time our entry points better, see if we're gonna, if it's a good trade. So we're gonna get into some beginner what they call indicators up here, and also just indicators you can see. So like I was going over, these are really kind of your first basic indicators are uptrends, downtrends, and then what I was saying earlier about the retracement. So it's very rare actually that you see like just a straight uptrend like that. It's very rare. Or I shouldn't say very rare, but it's not like a common uptrend. Um, you more see them like I have here, which is kind of an overall uptrend, but it's not straight up. So it's going up, and then there's a bit of a retracement, which means it tops out, kind of comes down a little more, and then goes up further. And that's just because of like the fluctuation, in the market. So if I'm finding an example here, I mean you can see this one here. This is a good example. So right, we're kind of coming up, and then do a retracement, and then it goes higher, and then I guess it's higher, and then more of a retracement, and then you can kind of see as I'm doing this, it just kind of going higher, retracement, and the retracements are where the red candles are at, pretty much, or if there's like a little bit of a group of red candles, or if you can see here, I'm looking at if I'm looking at this kind of area right here, I can see red candles and then green candles that aren't really as much of a move. They're kind of flattening out. So red candles and just green candles that aren't moving up that much, which will, which will kind of show a retracement. So those uptrends I was talking about with the retracements, those also apply to downtrends. So I found one here, which is, as you can see here, I mean, looking at the overall, it's a downtrend. But there are retracements, and I'm sure you might be able to already kind of see them. So downtrend, with a retracement here, then back into a downtrend, retracement, back into a downtrend. Oops. Right here. So as you can see there, it's downtrend, retracement, downtrend. So the point I'm trying to get across though is that you can see it's overall downtrend. So the one last sort of visual indicator we can use is what's called an engulfing candle. So if you can see here, this move where it goes high and then back down is called a reversal. So because it just reverses the move, and this one's a little more extended. So now that you know what a reversal is, well, how can you kind of start to see one before it happens? So let's say we're pretending this is real time, and you see this, you see the S&P 500 here start to really come down, but then you see this green candle here after this red candle. Well, that would be an engulfing candle, and what it really is that if I start to move this here, now you see it's starting to reverse, right? So what an engulfing candle is, right here, is so you can see it's bigger than the red candle. So this is the close of the red candle, and this is the open. So the open and the close, and then this is the open of the green candle and the close of the green candle. So you can see that this is a wider range than right here. So it kind of looks like it's eating the red candle. So it's engulfing it almost. So the example we just looked at was a downtrend reversed into an uptrend. So that can happen even in the inverse situation, like right here. And you might already be able to see it. It's just kind of the opposite of what was going on here. So instead of a green candle engulfing a red candle, it's a red candle engulfing a green candle. So as you can see, it's an uptrend and then reversed into a downtrend. And it's not a very dramatic move, but you can still kind of start to see it. So the next indicator and the real first like indicator you get through a chart instead of just visually is the moving average. As you can see right here, I have it pulled up, and what it is this green line. So if you can't see a trend, this will help you see it. So it's the moving average. So what that means is it's the price of the stock, the average price of the stock at that time. So there's different time increments you can use for the moving average. And if you go into settings here, again, this is TradingView, so it's most likely going to be a little bit different on your platform that you're using for your charts, but it's all the same stuff. It's just different how you might go about changing it. So I have, you see here, length as 20. So the 20 time period is a lot shorter term, like a shorter term moving average. So if you're looking at a day trade, you're most likely going to use that shorter time period. Now, if you want to use the shorter to midterm period, you're going to put in 50. So as you can see, that kind of changes it. This is like a longer term moving average. And then the last one we're going to use, which is pretty much the ultra long term period, is the 200. And this just measures a longer period of time. So after the moving average, we have what's called the VWAP, or the volume weighted average price. So there's kind of some similarities here. You can see moving average, volume weighted average price. So both of these are measuring the average price, but this one is more concerned with the volume relative to the price, while the moving average is just the number of days. So the past 200 days is the moving, or the average price for the past 200 days. So what does something like the VWAP actually tell you? Well, really all you have to worry about is when you see the price above the volume weighted average price, it's gonna, generally the rule is that it's gonna drop off a little more. So as you can kind of see here, it was above the VWAP line, and then it dropped below it, and then since it was below it, that really kind of means that it's oversold. And when it's above it, like right here and coming up over here, means that it's overbought. So because it's the average price relative to the volume is the number of people trading the certain stock. So give me a minute. Let me see if I can find the volume for this. Okay, so I pulled up the volume in the indicators section. I just went in here and typed volume, and then I just pulled it up right here. So you can see it here, and then this little section of the graph came up when I pulled it up. So what this is if I hover over one of these candles, and just keep your eye kind of in this area, that number that keeps changing. So if I hover my cursor over this candle, you can see that right around 5,500 people are trading this stock, or this index, within this 5-minute period. And then the next 5-minute period, only 136,000 people are trading it. So the volume was up here and dropped off over here. The red and green, it just kind of in the volume, it just kind of reflects like how many people are trading it versus where it closed. So since this 539K is red highlighted, then as you can see where my cursor's at, this candle right above it actually closed down. And that's not like always the case. Like the bigger number of volume, the whether it's going to close up or down, it really just messes with the volatility of the stock. So um, as you can see, kind of if I zoom in right here, not a whole lot of volume here. If you as I'm going over these candles, you can look up here at this number that's changing. So 42K, 54K, 14K, and that's why these candles just aren't very big. They're just kind of flattening out, not very volatile. So that it's kind of relative to that, not as much as if it's going to close in the red or the green. So as we're nearing the end of the video here, you might kind of be thinking to yourself like, wow, we started with like a graph that looked really basic and it was easy to understand. And I mean, Nick, are you the genius that came up with all these indicators? And even though I would like to be, I am not. So with these indicators, like the moving average, the VWAP, the volume's not. It's a little bit like of a indicator, but it's more just telling you how many people are trading the stock in that time frame. So just looking at the moving average and VWAP, and there's other ones. Like I mean, you can literally like go through all of these, but these two here that we went over in the video, what they really are, and so are all of these, they're just equations. They're not anything that's like, it's not some like insider trading info or anything. Obviously, like if let's say the price goes above the VWAP, it's not always gonna come back down. It's like and go below it. It's an indicator for what usually happens. It's an equation due to like the history of the stock and using that to try to determine the future. So that's really all it is. Don't rely solely based on indicators. You know, like I said at the beginning of the video, as traders, we need to use as much data as we can to make our decisions. So that's really what these indicators are. All right, well, with that wrapped up, thank you again for just watching these videos and subscribing to the channel. If you haven't already, it would really mean a lot to me if you did and left a like on the video. You know, I'm trying to balance this with school and sports coming up, so it's really not as easy as it comes out to be. So it would really mean a lot if you guys hit that like button and subscribe to my channel, and just showed that there's interest in these videos, because I mean, I make them for you guys, so you know, if there's not interest, I'm not going to keep making them, you know. So but yeah, thank you again for watching, and go check out the first video I made. I think it explains the financial markets really well and really more feeds into this video. So thank you again for watching, and take care.